How much money would be made from dividends if $100,000 were invested? Having a retirement fund of $100,000 is a good place to start if you're still in your prime earning years. But how much cash do you anticipate gaining from such a large investment? Would you be able to pay for your car, your mortgage, or even your retirement income with this amount of money available? Even if you don't have a job, seeing a regular cash flow arrive in your bank account might be enough to ease your mind. You might be amazed by how much money you get out of a $100,000 account based on your investing pattern. Examine the potential dividend income that might be generated by that and figure out how can you increase those profits so that you can achieve your objectives more rapidly. A personal finance and investing educator, it is my goal to assist others in learning about these important topics. Subscribe to this channel and give this video a thumbs up if you find it useful and if you're looking to improve your financial situation in the future. As a matter of principle, your income will be affected by where you keep your money. Investing in an index fund that tracks the whole S&P 500 is an option. Individual dividend stocks can be purchased to optimize your income growth, or a combination of both can be purchased. When it comes to dividends, the more aggressive your portfolio, the higher yields will be. Dividend-paying stocks have lower overall returns than the other type of investments, so you don't want to put all your money into them too soon before you plan to retire. Their lack of rapid growth can be attributed to the fact that they are older blue chips options. Having a high salary or income is great, but it doesn't really matter to younger investors. Because the S&P 500 tracks the stock market, you can reasonably expect the amount of dividend income if you invest your complete $100,000 in a fund tracking the S&P 500. As a result of your investment in this market, you can expect average income in total returns, including capital appreciation. The S&P 500 dividend yield currently stands at 1.5%, which indicates that you would obtain $1,500 per year, or an average of $125 for each month in dividend income from stock market. Payments are usually done every 3 months, so $375 would be due every 3 months or every quarter. Despite the low dividend yield, the overall return has been around 10% per year. For average investor, receiving this kind of dividend income is ideal because it offers a combination of growth and income that is nearly ideal. This makes it perfect for the average investor. It doesn't matter how much dividends a person receives, they will still see a substantial return of their investment over time. It is possible that investing in an S&P 500 growth fund will yield a higher growth rate, but at the expense of dividend income. The S&P 500's fastest growing companies would be included in a fund like this. People who don't anticipate retiring for a very long time and who aren't dependent on the dividends from their investments will find this to be an excellent option. This is likely to yield only 5% since many of investments are in tech companies that pay less for almost nothing in terms of dividends. Only $500 per year, $41 per month, or $125 per quarter can be expected in dividend income from a $100,000 investment. Fast-growing companies like Apple, Microsoft, Tesla, Nvidia, and Google will see their stock prices rise faster than the average. Rather than handing out dividends to shareholders, these companies prefer to invest in their company's growth. Because dividend income accounts for only 1/3 of that generated by the S&P 500, you would need to invest 3 times as much money in order to generate the same level of revenue. Due to the rapid expansion, you may be able to surpass that milestone much more quickly. A fund that focuses on dividends may be a good option if you're looking for a higher dividend income but don't mind having a lower general rate of return. The S&P 500 High Dividend ETF offered by SPDR is a great illustration of this category of fund. It invests in the S&P 500 companies with the highest dividend payments. Due to the focus on steady profits and dividends rather than growth, these funds tend to have a slow capital appreciation. Even if dividend payments are taken into account, the yields will probably be relatively low than compared to a higher growth alternative. So, only those with a pressing need for retirement income should consider making this type of investment, as long-term growth is not an option. Single dividend stocks that satisfy investors' criteria are popular among these investors. The features of a stocks can vary from person to person, but dividend investors tend to look for those that have a history of increasing dividends. to ensure that their share price rises. They also want a company with increasing earnings and profits, as well as a rising dividend. A bad investment is a dividend stock with a 10% yield but a yearly share price decline of 20%. But many new investors are enticed by such a high yield. Investments in individual stocks are the most difficult and riskiest, but they also offer the most potential rewards. It is simple to identify a stock that is on sale for various reasons, because share prices move independently. While some stocks are overpriced, many others aren't. When buying mutual funds, you can get a good deal because all of stocks are valued at the same time. Individual stocks purchases are what investors find most appealing. Think of it as buying a house that needs a lot of work but has a lot of potentials. On one side of town, an immaculate property is selling for more than the rundown one, but it's easy to get your hands on a cheaper one. Iron Mountain is an example of primary dividend stock. Storage, security, and asset management are all part of what they do. As a rate, it has one of the best returns among the S&P 500 stocks and therefore ranks among the highest yielding. 7% dividend yields a dividend income of $7,000 annually or $580 per month. If the stocks continues to rise, that's quite a bit of money. Investors profit and a good return on investment. The company's earnings aren't growing as fast as those of its competitors. Most people, however, would own it because of the dividends. It's not a good idea to concentrate all of your assets on a single investment. Buying Iron Mountain is an excellent demonstration of what you could do to earn money without doing any work. If you have, say, 10 high-quality stocks in your portfolio, there's a good chance that at least one of them is currently on sale. As a result, great bargains are always available. There isn't much dividend income to be created from a portfolio of this volume. Some people may be able to handle this amount of money even if they have a part-time job or receive Social Security benefits. Taking into account the average monthly Social Security benefit of $1,500, the prospect of a few $100s more to spend is enticing. If you paid off your mortgage and have low expenses, you may be able to live off your Social Security and dividends. In the case of retiree working $20 a week at $13 an hour, that works out about $1,000 a month in dividends. For the rest of us, it'll suffice to pay for transportation, a family vacation, or even comparatively tiny monthly mortgage payment. In despite of the low income levels, the power of reinvested dividends over time can indeed be significant. Dividend investing has become more prevalent among young investors, but they must keep their financial goals in mind when deciding which strategy to use. It is up to you to decide whether or not to invest in an income investment that tracks the market, or investments that outperform the market in terms of growth. It's possible to get the right balance by investing in a wide market financing like S&P 500. Take a look at the potential dividend income that each of these investments could provide. After that, you'll know what kind of financial strategy to use and how much money you'll need to put aside in order to meet your financial objectives. Sincerely, I appreciate your time and I hope to see you again in the next video.